Hello, everyone, and welcome back. My name is Austin Hageman, an advisor at the firm, and I am joined by our Chief Investment Officer, Henry Mercer. Henry Mercer. Welcome, Henry.
Good morning, Austin.
Yeah,
Maybe I should appear under an alias today.
yeah, right. Well, since I mispronounced your last name, I might as well try to make it up with a quick shout out. Henry has launched a new memo series called the CIO Vantage Point, which you can find on our website. It's basically a front row seat into the mind of someone with over 40 years of market perspective. 40 years, wow. And I'm just thinking about that now. We were just talking about Bruce. You probably started in the industry before Springsteen's Born in the USA was top of the charts, right? Yeah.
Yes.
Wow.
He was doing his darkness tour when I got in this business. So that's how long ago it was.
Wow. Sure. Wow. Yeah. You've been through a fair amount, right? The music on 8 tracks, the Cold War, right? Do you think that you've lived through more market swings than Bon Jovi had hairstyles?
That is probably right.
Yeah.
And Bruce has had hairstyles. So.
Yeah. So, but anyway, I couldn't recommend this memo enough. It's called CIO Vantage Point. It's like getting a director's commentary from someone who's actually lived every scene of modern market history. So make sure you take a look at it. How often do you plan on coming out with those, Henry?
We're planning on doing it monthly.
Monthly? Okay, great.
And perhaps even more frequently if the markets require maybe something said.
Okay, cool. Anyway, I digress. As usual, we're going to walk through some of the slides from our quarterly market update deck. The charts will highlight key data points that our investment committees consider when making decisions. So we're giving you a bit of a look at what goes on behind the curtain here. As always, feel free to drop questions into the Q&A box as we go along. We'll try to address them throughout the session. And if we don't get to yours, don't worry. Someone from our team will follow up afterwards. So before we dive in, we do have some folks who are not clients yet listening in. And well, our marketing team would read me the riot act if I didn't give a quick 30-second background on who we are. We are an independent registered investment advisor providing investment management and wealth planning for high net worth and ultra high net worth individuals and institutions. We're structured as a true fiduciary, which means we don't sell products, earn commissions, or get paid to push any particular investment. Plain and simple, our clients pay us for quality, honest advice, and that's the only compensation we receive. Our team also has institutional level access across both public and private markets, giving clients a broad, objective investment universe. We also have relationships with multiple private banks and other providers in the industry. So we aren't offering just one confined set of resources. Our clients have access to resources that extend beyond one company. All right, with all that said, let's jump in. I know there's a lot of chatter here. I feel like we're on the bubble watch. Let me jump to our first slide so we can dive in. And here we go. So what are we looking at here? On the left side of the chart, that gray skyline we see rising up from left to right, that's CapEx, which is just another way of saying capital expenditures. It's the money the big five hyperscalers are pouring into AI. So the hyperscalers are Alphabet, Amazon, through AWS, Meta, Microsoft, and Oracle. As you see the numbers ramp up hard, certain projections are calling for $350 billion in spending for 2025. That's up over 50% from last year, which was already up huge from the previous year. That's the most capital intensive build out we've seen in the digital economy since the telecom boom. All this spending pays for physical stuff like AI, data centers, chips, custom silicon, networking and power, right? If we swing to the right chart, now we're seeing industrial production. So how much real stuff the US is actually making. Since the CHIPS Act in August of 22 and the public launch of ChatGPT later that year, we see that production in semiconductors, computers, and communication gear has taken off and is outpacing the rest of the economy. So bottom line here, just to quickly summarize that, the AI build out, it's growing and it keeps compounding. The open question here is whether every dollar earns its keep, or whether we're in a bubble and some of this becomes overcapacity that benefits the long term more than the first movers that investors are currently flooding money into right now. What do you think, Henry? Are we in an AI bubble?
Oh boy, that's a loaded question. It's bubble is certainly front and center these days. It's a word that's become part of our popular culture. There's even an article in the Financial Times today that says bubble talk is breaking out everywhere. So there are elements to a bubble just in terms of the scale of the investment here, which is shown clearly on the charts. It's the largest in history, and it's growing. Uh, the capex expenditure from the hyperscalers this year, or an overall capex, was up 60%. It's forecast to be a very conservative investment yet next year, that it's going to rise another 20%. And as I said, that is conservative. But there is an arms race going here between the hyperscalers. And honestly, at the beginning of this year, I didn't even know what a hyperscaler was. Now it's probably going to be the word of the year. And whatever, I know there's a publication that puts out the word of the year, and I would bet hyperscalers in the running. But there's just a tremendous rush to build out the infrastructure to support AI. And the leading players are the most powerful companies in technology in the United States. So the scale of it and the enthusiasm around it has certain trademarks of a bubble, but it's perhaps too early to call it that now.
Right. And I guess this is a good time to plug the AI podcast, or the podcast we just had that was focused wholly on AI. We spoke with an AI investment expert. So, we looked at it from a market perspective. And then we also spoke with a expert consultant in the field who, took us through how she's been working with different companies and what she's seeing, which was just cool insight to how are companies actually using the chat GPTs of the world, right? So it's a good complement of both sides. Nick, if we could drop that into the whatever you call it, the Zoom board or what have you, that'd be great. Or you could find it on YouTube either by searching for Amplified Wealth. But to your point, Henry, it might be too early. When I think about whether we're in a bubble, my mind immediately goes back to the tech bubble that grew and grew and grew before it bursts. There are a fair amount of differences right now, and this time does look sturdier, at least based on where we are right now, right? The balance sheets today are not what they were in 1999, right? We talked about the build out, which is it's actually funded by mostly cash and robust margins. So these aren't unprofitable companies. These are profitable hyperscalers, right? These are big companies that are putting cash into this. Back in the tech bubble, vendor financing loops were a failure point. So sure, we are seeing capital expenditure loops, which I've seen memes about, I've seen articles about, where you have, one company, I think I have say something here, OpenAI putting money into Oracle, and then Oracle's putting money into NVIDIA, and then NVIDIA is then putting money into OpenAI, and there's this circle, which we saw that in the tech bubble buildup, but we saw that when they were doing that was being funded a lot by debt. What we're seeing now is that's being funded by cash. So you're not seeing that same leverage. Another difference is the monetization of AI is already happening. There's cloud demand, coding productivity, there's ads, enterprise AI tools. They're all generating revenue now. So it's not a build first and monetize later environment like we saw back with the tech bubble. Utilization is also high. So back in the tech bubble, companies were laying miles on miles of fiber optic wire, and they ended up overbuilding. At the dot-com peak, only roughly 7% of the fiber that was laid down was actually being used. Today's data center utilization is roughly around 80%, and vacancy is roughly around 1.5%. So supply is the bottleneck here currently, not demand like it was back in the tech bubble. So this isn't necessarily a build it and they'll come story. The story is looking more like they're already here. So what are we going to build, and how quickly can we build it? Also, capital is chasing real assets, not just ideas. Spend is anchored in chips, electrical equipment, and data centers, which are tangible capacity. We aren't just spending to get more eyeballs like during the dot-com bubble. So there are some pretty distinct differences between then and now that I think we need to take into account when we, question, are we in an AI bubble or not?
No, that makes total sense, Austin. I would say that where there are bubble-like characteristics, it's odd, but the behavior is coming from the hyperscalers. They're like behaving like, the FOMO retail investors piling into something. It's really incredible, and I worry that there is a lack of discipline in terms of their capital allocation. That historically these companies have generated huge amounts of free cash flow, which they've invested very prudently. Now you're seeing this spending of cash, and they're compromising their sort of asset-light business model, where they're spending a ton of money, and you just hope they get the return on investment that they have in the past. They are funding it without borrowing, essentially, which is really quite remarkable. And they're also at this point able to boost dividends and engage in stock buybacks and the like. So there's not an issue now, but you're just seeing certain things creep in. Like I read just something the other day that there is some worry now that private debt is entering the market to provide financing for some of these new power generation facilities. Meta has a large project in Louisiana, a power generation center, and a lot of the backing's coming from BlackRock and Blue Owl and names that we know. So maybe Meta's not borrowing the money, but other people are and funding it. And you just don't want it to get to the extreme that it did in 2000, where, like a Global Crossing was going to lay fiber optic all over the world and they borrowed a ton of money and then went bust. I don't see that happening, but I'm a little concerned about the lack of discipline from some companies that historically were the most disciplined.
Right. And to your point about the debt, debt can be healthy, right? We all know, we bought our first houses most likely with a mortgage, right? And you slowly pay it off, and as long as it's reasonable, right, it's a productive use of your personal capital. But when you get to levels like we saw before the financial crisis, for example, with people getting mortgages that they obviously couldn't afford or couldn't keep up with, that's when the trouble is. And it's no different in the business world, right? There is good debt out there, and then there is non-healthy amounts or bad debt out there, and we need to be cautious of both. To your point about these companies and they're acting differently, we are seeing the CEOs of these companies start acting like celebrities. I know Jensen Huang, the CEO of NVIDIA, right? There's pictures taken of him signing people's skin, right? Like you would think a rock star would. So that is always, something that's interesting. Maybe it's just commentary. Maybe it's a sense of their egos, and that could be a risk in and of itself. It may not be a huge risk, or it may be a huge risk. I don't know, but we'll have to see how that gets reflected in how he continues to manage the company. But you are in certain ways like the celebrity status that does feel bubbly, right?
Without question. I mean, that's a great point, Austin. I mean, the CEOs in this space, they're like rock stars today.
Right.
I mean, Jensen Huang and Mark Zuckerberg, all of them, they generate headlines. Also, Sam Altman with ChatGPT, he's the one who has no money to spend, but he's promising orders and business all over the place. Right. That's a bit bubble-like. And also, good old Masa Son from SoftBank who's found every bubble in the last 20 years. He's stepping up again. So it's going to be great theater to watch when you get these sort of huge personalities collide.
Right.
So it'll be fun to observe.
Right. Right. And we did have a question come in. How successful are economists and financial advisors in predicting or acting on bubbles? Is it something that can be planned for? I could take a first stab at that. I don't think economists or financial advisors are good at predicting anything. I think any good financial advisor will tell you that they don't know what tomorrow holds, right? Our goal is to manage risk, and thinking about and planning around bubbles is part of managing risk. We certainly don't want to run away from risk as managers of risk, but how do we interpret what's going on? How do we size allocations and things like that? That's really, I think, where we come in.
I agree. The other thing is that this is where asset allocation and diversification come in. That no one can really, you can predict a bubble, but no one really knows when it's going to break. And the worst thing to do is to take steps in preparation for something that you don't know the timetable. It's better just to maintain, a discipline with your asset allocation, diversify. You don't have to leave the equity space at all, but you move into just small cap companies, international. There are lots of things you can do to sort of tiptoe around the bubble. And the most important thing is don't get sucked into it. A lot of people will. That's just the nature of booms, that they can't resist getting in. And Warren Buffett had a great saying that you don't want to risk what you have and need for something that you don't need. And so our job as fiduciaries is to maintain the discipline, and we're always vigilant. We're risk managers, and we do everything we can to keep our perspective and not get swept away with emotion here.
Right. Right. And speaking of perspective, we talked about reasons why this time or the current environment is different as it stands than the .com bubble back in the late 90s, and then the bursting in the early 2000s. Just to root that on the other side, right, there is still some caution that is warranted. You have return on investment and depreciation risk. So hardware cycles are fast. Asset lives and resale values may be overassumed right now. So what do I mean by that? So AI is moving crazy fast, right? Those fancy H100 NVIDIA chips powering AI right now cost tens of thousands of dollars each. But the next generation, called the Blackwell, that's already coming out, and it's way faster and more efficient, like ridiculously faster and more efficient than those original H100 chips. So if you're a company or an investor, and you just built a massive data center full of the old chips, you might have originally expected to make your money back over, let's say, 5 years. But now everyone wants the new chips, and you're only 2 years into the investment. So, the old stuff that you have implemented still works. It just isn't worth as much anymore. So that's the risk here. Technology is improving so fast that some of these expensive projects could lose earnings potential before they've even paid for themselves. There's also power and permitting difficulties or risks. So power is a challenge. These data centers use a ton of electricity, and the grid in a lot of places just isn't ready for it yet. So even if companies have the land and the chips, they might have to wait for power hookups or pay more to get them to where they need them to be, which can hurt profitability by either adding to cost and or delaying profits. There's also the valuation problem, right? Valuations in a lot of the areas within AI are at edge. Valuations have surged. Just because an investment might be productive for an economy doesn't mean the price you pay won't be too high to ever get a meaningful return out of it, right? That's not to say, though, that these assets won't get you return, but valuation risk needs to be considered.
Yeah, and I'd also say that we hear a lot about the Mag 7 and the hyperscalers, and I'm sure we'll talk more about that in a bit. But there are many companies trading publicly in the United States that are trading at attractive valuations and are terrific long-term investments, even in the bubble. So again, it's part of diversification and keeping perspective. Some good might come out of this too. I mean, that's ultimately what we hope for. That with the need for power generation and the like, we could build out the energy infrastructure in this country. There's a tremendous amount of spending going on now. There was an article in somewhere today about like the shortage in gas turbines for power. That the order book is they just can't keep up with the orders. The demand is incredible. And 2 years ago, there are three major players in that: Siemens, GE, and Mitsubishi in Japan. Well, they can't keep up with it. 3 years ago, I think 2 years ago, Siemens only had one order. They sold one gas turbine in the United States. So you've got this potential boom in rebuilding our infrastructure, and there'll be revolutionary things going on in healthcare and medical research and stuff like that. The one thing I would plan for is plan that you'll be living longer, that with the medical breakthroughs coming through, that will be a key part of the asset allocation process, that you're going to need your money to compound longer. And to do that, you certainly don't want to get overly cautious with the equity market.
Right. We had a question that came in, and you touched on it a little bit, but what do you think of investing in traditional power companies? So if you're interested in that, the market expert that we had from Global X to talk to us about AI in that AI podcast that I mentioned, that's in the webinar chat, he does get into that a pretty good amount. But quickly, the market is one big breathing organism, right? And one area is feeding off to the other area. So you can invest in traditional power companies, right? And earn money based on their initiatives. Some of those initiatives being associated with AI, some of them not. Just like you could with the Walmarts of the world, right? Or the Targets. And I mention those names just as examples, not as investment advice. But if you think about if AI is going to work, right, and AI is going to keep moving forward, for every dollar a company spends on using AI to improve their business line, they're going to want more than $1 back in return, right? So there is significant potential for companies across the board to improve their bottom line, to make themselves more efficient, right, to lower cost, maybe to increase or better the client experience, right? Which would theoretically add more dollars to their bottom line, which means they should do well. So this AI story, if it works, and it looks like we're on the right trend, it's not just a semiconductor story like it's been. It's a big picture. It's an overall economy story.
Agreed. And what you hope for is that AI does not end up with a similarity to past booms like railroads and things like that, where there was just a complete overbuild and misallocation of capital and downright, let's put it this way, fraudulent behavior and
Right.
things like that. Right now, there are no signs of that at all, but we'll see.
Right. Yeah. I mean, I would put money that eventually that's going to happen, right? There's no signs of it at all right now, but I think just human nature, eventually we're going to overdo it. So again, it's about, as investors, it's about managing risk, not necessarily running from risk, right? I don't think we should be running from AI, but we still should be considerate of the risks surrounding it. So we keep moving forward here. As we know, all of that development, right? The chips, the data centers, the excitement around AI. It's not just an economic story, an efficiency story. It's also a market story, which we've been talking about. And investors have certainly been chasing this story, and it's reflected in, the Mag 7 type names. And when people get excited, prices move faster than profits, and that's where valuations come in. And on the screen right now, we're looking at how far those valuations have stretched compared to history. And if you see where we are right now, we're actually entering tech bubble style valuations, which is interesting. How do you think about all of this, Henry?
Well, first of all, the stock market, if you look at it historically, is at a very high valuation level. The S&P 500's trading about 23 times forward earnings. Austin, as you said, it's the really only comparable situation is the dot-com bubble of the late 90s. But I think there are different characteristics here between now and then. We do have the concentration of the Mag 7, the top 10 or the 10 largest companies in the United States publicly traded comprise about 40% of our stock market. That is a very, very high level. But in terms of how today's Mag 7 are valued versus the leading companies back in the dot-com bubble, today's companies are cheap by comparison. Cisco was trading 100 times earnings at the peak. So investors were getting $1 of earnings for $100. I mean, it made no sense at all.
Back in the tech bubble.
Back in the tech bubble. So it's different. The psychology is different. And you could make the case, people have been saying this market has been overvalued historically for the last decade. And you see what's happened. We're at all-time highs.
Right.
So valuation, in a sense, in the short term's a lousy indicator because the market can trade at overvalued and an overvalued nature for a long, long time. And we're seeing that now. And so the other thing beneath the surface with the concentration of the biggest companies, there are a lot of companies sort of hidden and not known or lower profile that are trading at very reasonable valuations. So the overall level of the market might be one thing, but you don't have to chase the high valued stocks. You can look for value, and the psychological aspect of this is much different than the late 90s.
Right. And to your point, valuation is just one part of the story. Looking at valuations is kind of like assessing someone after a first date, right? It's all interesting top layer stuff, but you need to see what's under the surface before you can make a real judgment. And I think if we go to the next slide here, we make an attempt to digging a little bit deeper. So here we're looking at the S&P 500's profit margin in orange and its price to earnings ratio or PE ratio in blue. What we see is that valuations as measured by the PE ratio tend to follow profit margins over time. So when corporate profit margins widen and they get more profitable, investors are willing to pay more for each dollar of earnings and PEs rise, right? Valuations rise. And when margins compress sharply, valuations tend to come down and stocks look cheaper on a PE basis. Henry, do you think this provides any justification for what we saw on the other side for why investors are willing to pay up for stocks right now?
Yes, I do. I mean, the fact that margins, in a sense, are outperforming earnings, it's very, very positive, and it makes the case for the market being overvalued, or not overvalued, but highly valued, and it just shows a lot of strength in terms of the profitability of U.S. companies.
Right. And I think a common misconception is price doesn't have to come down for the price to earnings ratio to normalize. So you could think of the PE equation as a rubber band with 2 points. So at one point you have the price. On the other side, you have the earnings. As as the PE ratio gets higher, that rubber band stretches where the price stretches far in front of the earnings. Okay. Now, in order for the PE to normalize and valuations to normalize, you need one of two things to happen. One, you could have prices retract back, right, to normalize that rubber band. Or two, you could have earnings catch up, right? Investors are betting based on the profit margins that earnings will catch up. And if profit margins continue in the direction that they're going, there's a real chance of that. The question is, will earnings catch up to price? We are seeing some tricklings of that, right? So far this year, some of the larger tech companies have seen their earnings grow quicker than their price. I wouldn't say, though, that this is something we should count on, continuing with extreme certainty. But I'm also saying, we shouldn't count on prices falling precipitously over the short term either with extreme certainty. We have to intelligently weigh the possibility of both.
And one could make the case that margins will remain high, and it could be a byproduct of AI's impact on overall business.
Right.
It should be very positive for businesses. I don't know what that means in the shorter term for employment, but in terms of profit margins and efficiency of business, it should be really positive. And that again would justify higher price earnings ratios.
Right. If company A is more efficient at growing their bottom line than company B, company A should grow more over time, right? And in that same sense, it's almost like today's companies are company A and the companies of 30 years ago are company B. Is it practical to think that today's companies could be more efficient at growing their bottom line than a company 30 years ago? Probably, but we're also looking at valuations, trying to compare them as apples to apples. So we do need to take into account that there is a different shade of apple, right, that we could be dealing with as well.
You really can't, do the apples to apples. The level of price earnings ratios is dependent on so many factors, interest rates, all sorts of things, and to compare one era exactly to the other is impossible. What I would say today is that first of all, interest rates are lower than they were back in 2000. And the background psychology of the market is completely different. I mean, I was in the business and I was running my own company during the dot-com bubble, and I can tell you that it was the most difficult period that I ever went through because people were just so swept up in the frenzy. They would call in with symbols from home. They didn't know the name of the company, but they were watching Squawk Box.
They knew the letters.
Say, well, what do you think of QCOM? Qualcomm was the big stock back then. Mm-hmm. We're not really seeing that. There's small pockets with the meme stocks and companies like Palantir, for example, that is very richly valued. But you're not seeing it. You're not seeing IPOs like en masse. Mm-hmm. We're seeing the IPO market sort of come back to life a little bit, but it's nothing like way back then.
Right.
So the value is high, but that in and of itself doesn't worry me.
Right. And just to, I guess, further compare the tech bubble to what's going on today, what we're seeing today on the screen is we're seeing profit margins at around 13.5%. Right. Over the last 5 years, we're seeing that profit margins have widened, roughly 4%. Back in the tech bubble, we don't show it here. The profit margins for the U.S. economy at the time were about half of what they are today. And the 5 years before the bubble burst, profit margins only increased by about 1% or 2%. So just another exclamation point on, this time is different. It doesn't mean that says nothing about if it's going to play out different or not, right? But this time is different, so that there are things we can't just stamp it with a certain label, right, and run.
Exactly.
So we're actually going back in time here. So up to this point, we talked about the numbers, right? We talked about valuations being high. We talked about profits being strong. Here's something I find interesting when thinking about if we're in a bubble or not. If we were really in a bubble, you'd expect people to feel euphoric, right? That's what we saw back in the tech bubble buildup. And let me just I guess just to be clear here, when we see this line rising, that means people are more optimistic about what the next 12 months hold for the US economy, right? When we see the line dropping, they are more pessimistic, okay? And back in the tech bubble, right? So it was right around here, we saw people were overly optimistic, right? Very bullish. That sentiment that you were just talking about right now with calling in with stock tickers. We fast forward to today and we're seeing consumer sentiment all the way down here, which, that is actually closer to where sentiment was after the tech bubble burst, not during it, right? And I guess actually is even weaker now than it was back when the tech bubble burst. We're still at about financial crisis levels down here, right? And when you look at the research and you say, all right, well, how has the market performed when everybody's feeling very optimistic versus how does it perform when everyone's feeling very pessimistic? The market tends to, over the next 12 months, see high double-digit returns when the market is very pessimistic like they are right now. When the market is over optimistic, it's low single digits. On average, it was 4% over the next 12 months when people are over optimistic. Isn't that interesting to think about?
It's a mystery. Very simply, it's a mystery. If you go back and look at the low points of consumer sentiment on the chart, they basically are all associated with stock market bottoms. 1979, 1980, that was the hyperinflation period. Volcker was raising interest rates through the roof. You look further, you go back more recently, November 2008, and then a great buying opportunity. There was when the US's credit rating was downgraded in August of 2011. One of the great stock market buying opportunities of all time, and confidence is in the tank. And the same thing here. It doesn't make any sense that with the stock market at a record high, that consumer sentiment is so low. It's an aberration. And I know we've talked about it around here and trying to kind of figure this out. The only things that we can sort of come up with is it's the political dysfunction today. The day-to-day disparity of wealth in this country, where you've got the haves and the have-nots, and the have-nots are not happy at all, and they're told every day on social media that life stinks, the other side's awful. It's the old joke about Woody Allen had about that we have two paths. One leads to destruction and the other leads to obliteration. And let's hope we have the brains to choose wisely. I mean, it's just this depressed state that really has nothing to do with the economy's doing great, stock market's at all-time highs, Fed's lowering rates. It's a great environment to invest in a sense. But the sentiment part of it it's just, I think everybody is just depressed. Long story short.
It is a conundrum. The market's doing well. Sentiment's low, which normally points to higher future market potential, right? We just explained how, this time looks different than the AI bubble did, at least as it stands right now, which are all very cautiously optimistic. I hate that word because I feel like that's the word people use when they don't want to get caught with their pants down, but they want to say they're bullish. And they understand that the market could flip on them at any second, but they still want to sound like they're being predictive. But I guess just to counter all this, because it does exist, and it is something we need to be mindful of, is what does those valuations that we pointed to earlier, what does that point to? And right here, what we're looking at is two versions of the S&P 500. The first version here So this triangle here, that is the traditional market cap weighted S&P 500 index where the largest companies have the most influence. And we're marking off here on the chart where the current price to earnings valuation stands at. We're also looking at an equal weighted version of the S&P 500 where every company counts the same. So the big names don't dominate the data. That's this triangle here, marked off by the current valuation when you take that sample of an equal weighted S&P 500. What you find is when we're looking at back in history, and what this is showing us is when a valuation was this point, on average, what were returns over the next 10 years? Okay. And historically, when valuations are around where they are for the S&P 500 traditional cap weighted, which is around 23, that's the price to earnings value right there. When it's at 23 on average, future returns over the next 10 years are generally around 1.5% on average over a 10-year period. When we look at the equal weighted index, where valuations are roughly 17.5, and then we look at the corresponding 10-year returns, we're seeing that on average, returns were roughly 7%, which is more normal for the US stock market. Normally, the US stock market, depending on the decade, is going to return you anywhere between 8 and 12%. So 7% gets you sort of there. What comes to mind, Henry, when you think about this?
Well, I guess the first thing that comes to mind that for investors, when markets are kind of valued at this level, it's in a sense to lower your expectations. Just be rational. The history of the stock market is one where you have secular bull markets that last a long, long time. And then they reach kind of a level of high prices and maybe overinvestment. Everybody's in it. And then you go through sort of a sideways periods. And it's not unreasonable to expect a lower rate of return going forward, just where we are now. But that shouldn't influence how you go about investing. That you have to keep compounding. That's where diversification comes in. And as I said before, a high valued stock market, there are always opportunities within. So you've got to stay with your allocation, rebalance, maintain discipline, and just lower your expectations. I mean, if this chart's wrong, well, everything's going to be wonderful. But the market from time to time tests your patience. And the key is just if you're a long-term investor, you just have to understand that returns do return to the mean, and that potentially could happen here. And quite honestly, if it does, it would improve your odds of your overall long-term returns being higher than you expect now. A period of sort of slopping around sort of sets the table for the next rise. So I wouldn't be alarmed by this. It's just, it is what it is.
Right. And I guess two caveats in digesting this information. So it's important to keep in mind that this chart is only looking at 10-year time period returns. Historically, P/E ratios have been a terrible predictor of short-term returns. In fact, they've only explained about 20% of what happens over the next 12 months. So P's tell you almost nothing about how the market might behave in the near term or even over the next few years. But when we stretch that out to a decade, the relationship gets a lot stronger. So over 10-year periods, valuations have explained roughly 70% of the variation in returns. That's meaningful, and it tells us that valuations tend to matter for long-term outcomes. But still, that leaves 30% of the time where markets did whatever they wanted. And anyone who's ever been to Vegas knows you could still win big even when the odds aren't in your favor. So yes, valuations help set expectations, but they don't write the script. I'll also, bring back, we talked about profit margins. We talked about the differences between now and the technology bubble. We're looking at historical data and comparing it to current the current economic environment, and there are definitely differences, right? The stocks today are more efficient in generating bottom line numbers than they were yesterday, or 30 years ago, or 40 years ago, or even 25 years ago, right? So I think what's important to consider, and you brought this up, is two things. One, this does not mean that the market needs to drop precipitously. It may mean that returns may be lower than average. This is currently pointing to a 1.5% 10-year, but it doesn't have to be that, right? The great thing about averages is outcomes are never exactly on the average. They're either much higher, much lower, and it averages out, right? So plan on lower returns. Returns that still outperform bonds, okay, because you are taking on more risk with stocks, but also be considerate of where you're taking risk too, right? When we look at the equal weighted S&P 500, valuations are lower. It points to a higher return potential, right? There are currently less valuation risks associated with the rest of the names in the S&P 500, other than those top names. So, being mindful of not secluding them from your opportunity set is helpful. But at the same time, we also should respect those top 10 names. Those are different companies, right? We need to respect their ability to generate profits, right? And not necessarily run from risk, but learn how to think about it constructively and manage it.
The other thing to remember is that the best businesses, they tend to trade at higher price earnings ratios, and the deep value crowd, they miss that. They'd rather buy like a steel mill, but that's high risk stuff. To really win in the stock market, you own the best businesses, and we do a lot of that here. We have our certain core blend portfolios. We screen very heavily for really high quality factors that would comprise a decent business. And actually, we look for the best of the crowd. And so we'll be doing that all along. So it's just, you just don't know what, honestly, the one factor that will influence the market over the next decade, it's interest rates. And no one has any idea what's going to happen there. I mean, no one can forecast interest rates. And I would say the one thing that I would worry about the most is if inflation somehow got out of control. Because the bear market of the 70s, that was caused by inflation, losing our vigilance against inflation. And so that's something we will be keeping an eye on very, very closely. But higher inflation also means higher bond yields, things like that. There'll be a lot of things we can do. If anything, there are more things we can do in the tough periods for you. So as I said, it's an interesting picture, but it's like it doesn't necessitate any significant action other than doing what we always do.
Right. So we have about 10 minutes left, and we have a bunch of questions here. So I want to try to get through at least two of them. So someone brought up gold, and I think that's a pretty smart question. We've talked a lot about sentiment towards stocks, where your sentiment is cautious, yet prices remain high. This cautious optimism. In contrast, we look at gold. Everyone seems to love it again. Prices have surged. Headlines are calling it a new era for gold. Gold euphoria seems to be creeping in. And I don't know. Do you think we're in a gold bubble, Henry?
Again, if it's a bubble, it's probably going to go higher. But I have no clue.
Right.
Just I can go by that gold has had its moments historically. It has these incredible runs over, let's say, a 5-year period. And then it falls. It goes to sleep. And I can understand that there are animal spirits in play here. There are concerns about just currencies in general, too much debt in the world, geopolitical tension. Gold is perhaps more tangible than cryptocurrencies, but as we're investors, gold's a speculator's game. That they don't ring the bell when you should get in, and they don't ring the bell when you should get out. And it's having its moment. It's happened throughout history. I was talking with some people the other day, and my first year in the business back in 1979, I remember passing my Series 7 exam early in 1980, and I went into the office manager's office, and we were all talking about it. The news came over the ticker that the Hunt brothers had gone bust trying to corner the silver market. So I've seen this before, and it's a speculative game. Anybody in the market, if you're going into it, like, you've got to go into it with your eyes open. There's no harm putting a small allocation in your portfolio, but in long term, it doesn't generate cash. Warren Buffett once said that if you took all the gold that's ever been mined, it would fit in a 65-foot cube, and you could look at it, but that's about all you get. I will acknowledge that in certain parts of the world, gold is an important part of the culture, particularly in countries that are less stable, volatile currencies, government changeovers. Tangible gold to them is a currency. But in the real world, or in the more developed world, it's not. So this is a speculative episode, and we'll see what happens. Again, it's kind of fun to see. Yesterday, the gold was down 5%.
Right.
And but who knows? It'll get more volatile when you're getting near the end. That's all I can say.
And what I find interesting, so there's a lot of things you could point to as the original catalyst for gold's surge. It didn't actually start surging in 2025. It was earlier. There was inflation concerns, geopolitical risk, diversification. One of the biggest drivers has been central bank buying. And that trend really picked up in 2022, 23, and 24 as central banks rebalanced their reserves and reduced their reliance on the US dollar. But this year, we're starting to see a shift. Central banks, they're still buying, and I think they always will buy, because as a central bank, you're always collecting more money. You have things that are yielding something, right? You need to put that cash somewhere. So you're either you're gonna keep rebalancing your portfolio. So just as I expect them to, keep buying asset A, I would expect them to keep buying asset B to some certain extent. But we're seeing that it could be slowing, right? And definitely has slowed compared to those last 3 years. But in their place, the retail investors have stepped in. So ETF flows and physical demand for individual investors has ramped up sharply in 2025, suggesting that the rally is now being fueled more by the crowd than the institutions. So to your point about speculation, when the price starts to heavily detach from that fundamental view, and it's very hard to get a fundamental view on gold anyway, because it's not a cash generating asset. But when it stretches like that, you have to believe, or it's reasonable to believe, that there's speculation built in there, and which just forces me to lean more towards the cautious side, especially when you consider stocks and gold have had similar volatility over time, but over rolling long-term periods, stocks tend to beat out gold, and stocks, even when the market's down heavily, I could still rely on the fact that I'm holding an asset that generates earnings and generates income, where gold doesn't do that. But just one more question, where we got about 4 minutes till the planned time, but let's see here. So do you have any concerns about the government shutdown cutting into the market? Also curious for your take on Jamie Dimon, almost always chirping about political uncertainty, persistent inflation, tariffs, credit markets, etc. What's your take on this? Has he become the boy who cried wolf? Oh. You want to take that first, or you want me to take a stab at that?
Well, I'd love a stab at it, but you can go first.
So what I would say is, so starting with the first part, the government shutdown, we're entering the third week of it. This isn't the first time the market's been shut down. Back in 2018 and 2019, we had a shutdown that lasted so long that TSA agents started calling in sick. National parks were overflowing with trash. Economists estimated that it ended up shaving about 11 billion off of our GDP. However, the US never went into a recession, and most of that 11 billion was recovered once the government reopened. I think that they're two separate beings. The government is one institution among many that live and breathe in the U.S. and among, even many more that live and breathe throughout the globe. So I would expect that maybe, a shutdown could add to some additional volatility, but in my personal professional opinion, I don't think that any government shutdown is going to have a long-term impact on the stock market itself. We flip to Jamie Dimon. I'll be quick here. He's managing a bank. His job is to be safe and risk-minded for a bank, not safe and risk-minded for your average investor. His mindset is different than what your average investor's mindset should be. His should be, how do I avoid instances that may blow up what we have going on at JP Morgan, right? He definitely needs to stand in a more defensive posture, I think. So I think that his goal or part of his job is to be the boy who cried wolf. Where are the risks? So then JP Morgan can figure out how they can mitigate or avoid them, and move forward in more of that defensive stance. I don't think that's how a U.S. investor should position themselves or think about the market. Just the way Warren Buffett, he's managing around and the risk profile of insurance company. I love when the media comes out with, he has, X amount of cash. This is, he's so conservative. Everyone should be scared. Well, no, he has X amount of cash because he's managing insurance payouts and things like that. He's not managing a portfolio the same way an individual investor would, and neither is Jamie Dimon. So, partly agree with you, or agree with maybe you're inferencing, but part of it is I think that's just the nature of the beast, right? That's who he needs to be to lead JP Morgan and a bank to success.
You said it, Austin. I mean, Jamie Dimon is a banker, and he's a legendary banker. I mean, if you look at them, he's probably the greatest in history.
He sits on the top. Yeah,
we've had a lot of. If you look at the history of the country, we've had a lot of awful bankers, and so I mean, his caution. He always speaks probably more cautious than he actually, watch what he's doing. His case that yes, there are problems in the credit market, and there's more than one cockroach. I mean, we're seeing it now, but that's his job. He talks that way. You got to watch what Jamie does with his money. I mean, if you would bought JP Morgan stock every time he made an open market purchase, you'd have a fortune. So he's very good with money, and he's someone to listen to, but he's not gospel. No one's gospel in this business.
Right. So we're at 1:00. So one more plug, the Financial Planning Committee is coming out with a newsletter that will cover financial planning topics related to the One Big Beautiful Bill. We got an inside look at it. It looks great. There's a lot of great content there. I'm not exactly sure when it's going to come out, but I know it'll definitely come out before year end. So keep an eye out for it. A lot of good stuff, to help you, position yourself for the year forward. So keep an eye out for that. And then as always, appreciate you guys tuning in. Please feel free to share the link when you get it for these, share the recording when you get it. This isn't just for clients, like I alluded to in the beginning. We're here to help give you an honest opinion about, what we see going on in the markets, and an honest opinion about how we think, people should be thinking about this and digesting it, right? Cutting through that noise. So please definitely share, like, and all that fun stuff. And thank you again for joining us today.